Hello, this is Robert Casey, and this will be a presentation on taxation of Social Security and how it can result in higher taxes in retirement and other implications of taxation of Social Security in retirement. In 1983, President Reagan first passed legislation that first made Social Security taxable. They came up with a term called provisional income, which is your adjusted gross income plus 50% of your Social Security income. For singles, when your provisional income went over $25,000, you'd have 50% of your Social Security taxable, and $32,000 for married filing jointly, and a maximum of 50% of your Social Security would be taxable at all. The other 50% would remain tax-free. These thresholds have not changed in 31 years. Only higher taxes and for higher incomes were added later. In 1993, President Clinton drastically modified the Social Security. He changed the 50% bracket and made it ranges. Of course, nobody now pays these 50% taxes, or very few do. Clinton's law really changed it to where 85% of your taxes will come at higher clip levels, and a maximum of 85% of your Social Security would be taxable now versus previously 50. What's an important conclusion is a large portion of your Social Security will be result in your normal IRS tax brackets increased by 85%. Since the passage of these laws in 1983 and 1993, the thresholds for Social Security taxing remain the same, and they have never been updated for inflation. In 1983, only 10% of the taxpayers were affected by this taxation. Currently, about over 20% of all Social Security receiving people are affected. 20 years from now, 1 out of 3 individuals will be receiving taxes due to Social Security benefits. These laws continually to include more and more middle classes to pay these taxes. Since there is no adjustment for inflation, these taxes are progressive. They really are yearly increases for middle and upper middle income class people. Basically, the way this works is most of your taxes are increased by 85%. And it's not really Social Security, it's really your other income after your Social Security. And the net effect is the lower part of your traditional 10% bracket is not affected. The higher part is increased from 10 to 18.5. The 15 is pretty much fully increased to 27.75, and a portion of your 25% bracket is taxed at 46.25%. Then it reverts down to 25%, which is normal because at that point in time, the maximum amount of Social Security that you can collect is already taxed. But there's a couple other twists. Provisional income includes more than just ordinary income. If you have dividends and capital gains, they're also increased by 85%. Also, provisional income includes interest on tax-free bonds, so this source is not really tax-free when you have Social Security benefits. Factors that increase Social Security taxes. Basically, any income from any other source other than tax-free sources such as Social Security and Roth distributions, all these taxable incomes increase the impact of taxation of Social Security. So your RMDs or just normal distributions from your 401ks or IRAs, income from investments, income generated by taxable accounts, income from working or business profits, pensions, you convert lump sums into annuities or purchase annuities. All these have to be counted before, if you have this kind of source of income, you use that first, and then you take out your 401k. So that's a lot of potential sources of income that could prohibit you from not being taxed on Social Security. Delaying Social Security is almost the best overall strategy because it maximizes a pension fund that it's supported by the government, as well as it's tax-free, which no pension will ever be that desirable. So taking Social Security early is going to result in smaller Social Security income, therefore it decreases the impact. But delaying Social Security, since it makes Social Security larger, means there's going to be a larger range where Social Security is taxable. Social Security will probably be your largest source of tax-free income and for people earning around $100,000 a year. Filing status makes a difference, but they all remain impacted. Married people, since they both have two full Social Security incomes, they're hit the hardest. Next hardest is the single or surviving spouse, and that's because they have fewer exemptions, fewer smaller standard deductions, and the thresholds for different tax rates are more constrained as well. And the married spouse events are hit the least, but they're still significantly impacted as well. So if you're still working, you can lessen the impact of this. You can switch from 401ks to Roth, so you have a more even balance between those two. Don't do this unless if it increases your incremental tax rate. Both you and your spouse can also contribute $11,000 if you're under 50 or $13,000 per year to a Roth IRA outside of your employer, as long as your income falls below the phase out of eligibility. Given 5 or 10 years or even 20 years, this can really amount to a lot of money. If you're changing jobs, considering taking your 401k and rolling it to a Roth, this is another major strategy if you're still employed. If you retired, you still can delay your Social Security, and by delaying your Social Security, you can do conversions during the time between retirement and hitting age 70. Also, you can take distributions from your 401k, reducing the size of your 401k and the subsequent RMDs. You really need to examine your required minimum distributions of your 401k over the entire horizon of your retirement life. Make sure that your income for your 401k distribution never get anywhere close to your RMDs. You just don't want to be forced to take RMDs and pay income tax for income that you don't need. If you're thinking about converting a lump sum or annuity, you might want to rethink this option because it will create an income stream that can't be eliminated during retirement. It's really critical to understand that Social Security income is really tax-free. And the way that Social Security gets taxed is all your other income really gets increased taxation due to Social Security. And this is a very important fact that even a lot of CPAs miss. It's important to track real income versus taxable income. When I say real income, not income that's forced on you by the IRS, which doesn't generate any actual income. It's just taxed. And so you really need to understand these incremental tax rates, because then it'll affect your advice of how much IRA to Roth IRA conversions you can do. Because when you do those kind of conversions, you want to at least convert at the same rate as you're going to be taking it out as in retirement. And of course, better if you pay higher taxes in retirement, that's even better. It's important to understand that reducing your taxable income can greatly reduce the possibility to eliminate taxes due. If you don't have too many other sources of income, you can just totally eliminate all this taxation. Converting more of your 401ks to Roth will give you the flexibility to adjust your income each year. In other words, if you have some higher taxation, instead of taking out a 401k, if it's not too large, you don't have to do RMDs, you can take part of Roth and take some of that 25% tax money and pay down some 46 and 28% tax rates. Never convert every bit of your 401k to Roth, because you're always going to need enough income to offset your standard deduction exemptions, which over time can really take down a $200,000 to $400,000 IRA. Assume that this whole presentation assumes that you're new retirement in your early 60s and that your 401k IRA assets far exceed your Roths, since Roths are a relatively new thing to most corporate employees. All the assumptions there's always assumptions in all presentations. This assumes that you have enough income during 35 years to have maxed out your Social Security, which means you earn currently, in the lower $100,000 range. All scenarios assume standard deductions instead of Schedule A deductions, which could be more, and assume that you're already 65 years old or older for both you and your spouse, so you get the additional deductions for that, and that you get one or two exemptions based on your marital status. All tax issues are adjusted for inflation as per tax laws. The standard deduction and exemptions go up every year, an average of 2.1% for the last 10 years. The thresholds for tax rates change, go up around 2.2% a year, and Social Security cost of living adjustments have averaged around 2.5. And because we all know that COLAs are not high enough for middle income people, I actually went up to 3% inflation for real income needs to have some difference there. For filing jointly, people where only one spouse gets the spousal benefit, so that spouse gets a half of the higher income earning wage earner. It assumes about around $110,000 income before retirement. And this was adjusted down to $85,000 based on removal of 401k contributions, Social Security tax, and Medicare taxes, plus the taxes associated with those. And then I removed the $8,000 of federal income taxes to result with a $77,000 pre-tax total income needs, because your taxes are going to be very different in retirement than they are currently. This chart is really the meat of this presentation, and I know it's a very heavy-duty chart. It varies every year because all the tax rates change every year. Your income needs, your Social Security income all get adjusted every year. This is for a scenario where it's married and one of the spouses gets spousal benefits only. So this is basically 1.5 times the normal Social Security of one person. In 2013, the maximum Social Security with spousal benefits is around $57,100. That's the first flex point, because at that point in time, you have all your Social Security before you have any non-Social Security income. The next flex point is when your provisional income is $32,000 and then $44,000. But I won't spend too much time on those because you'll never see those if you max out your Social Security. The next flex point is when your AGI equals $22,400, which is the current amount for exemptions and standard deductions, so you're still at a zero tax bracket. But at that point in time, you have collected $57,100 in Social Security and $15,964 of non-Social Security income, totally tax-free, which is a real advantage of maximizing Social Security. The next flex point is $77,000, which is described on the earlier assumption screen, and that's the actual flex point for the mythical person that we're doing. And then you throw on taxes to get to add extra $100 for taxes. And then the next flex point is $17,850, which is the end of the 10% and beginning of the 15% bracket. And then $72,500 is when the 15% brackets and the 25% bracket starts. Then under taxable Social Security, the next flex point is $40,535, which is 85% of your total Social Security, and when you stop paying incremental taxes for Social Security. And the last flex point is when the 25% tax range ends. The main thing to notice on this is that you, in no time other than the exception of a small amount of money at 18.5%, you're you're going to be potentially in your 25% higher. Right now, that's not the case in 2013. Unfortunately, the other table doesn't have enough width to actually show you how real income tax incremental ranges should be calculated. And so I took the real income range, basically Social Security, and then adding on non-Social Security tax, and keep a range and do the deltas for that versus the real taxes you're paying. And when Social Security is being taxed, your IRS rates get increased by 85%. So the 10% goes to 18.5, the 15% goes to 27.75, and the 25 goes to a whopping 46.25%. For those interested, I used the 2014 rate for Social Security, the maximum you could get, and this shows you kind of the calculations of how to do Social Security uh, for a spousal benefit scenario. Next, we move out to 2024, and notice that the 18% area is getting much, much smaller. So over time, because the provisional income are not changing with time, the standard deductions keep creeping into that and eliminating the 18.5% over time. The only thing you should notice here, again, there's only, you're going to be, if your income need is 106,000, you're at 27.8% or higher, except when you revert down to 25. So you'll never see lower than a 25% tax bracket, even though the IRS says you're in a 15% tax bracket. Again, as a sanity check, here you can do the calculations again to see what the real incremental tax rates will be in the year 2024. And to give you an idea of what happens 20 years from now, as you notice that you still have a smaller, and now all of a sudden it's gotten a little bit bigger for 18%, but you still are dominantly in the, you start out at 27 and never have more, less than 25% tax bracket any time. On this slide, I not only gave the real incremental tax rates, but I gave all the gruesome details of how the amounts were calculated. And on the very bottom, you have to pay taxes on taxes, and then when you take those taxes out, you have to take taxes on those taxes. So it's an iterative type thing. So I took it out 5 levels. And instead of really being taxed at your current incremental rates, you're really taxed at 38% on that. You need 38% more money to cover the taxes versus what would seem more straightforward as 27.5. This is one example of 10 years from now for 2 people getting full benefits in the year 2024, and you notice that there is a lot more money in the 46% range, and it actually reverts back down to 25%. So if you increase the amount of Social Security benefit, it does shove and it widens the range of taxable amount of Social Security, because now you have 50% more Social Security than in the other scenario. This scenario applies to the surviving spouses of the other 2 married couple scenarios, as well as singles. And as this shows here, you will be taxed partially at the 46% tax bracket. But there again, the main point is not these higher brackets, but that they all exceed or equal to 25%. You obviously need to have some variations in this analysis for your own personal needs. The previous tables only are for those who qualify for the maximum amounts of Social Security benefits. But for those who still only get 80 or 90%, the vast majority of this still applies. Obviously, people who depend only on Social Security and did not make $100,000 a year, those people would have to do their own analysis. Previous tables are only valid for specific years, and you must adjust for each year because everything has to be adjusted for inflation. It's key to understand how all these inflationary factors play into each other. The previous tables always assume one income scenario, but you can modify the tables quite easily and put your own income in if you've maxed out your Social Security. So these tables really can be used by anybody who maxes out their Social Security. Understanding the flex points in the various columns are key to creating variation in these scenarios. So if you have a different Social Security benefit, or you want to look at different years, all these have impacts on creating new tables. Since all inputs except for the thresholds for Social Security are just inflations, the table within one reporting status, such as filing singly, don't really vary tremendously over year to year like you would think they would. Another really important factor associated with taxable Social Security is the RMDs, which are required minimum distributions. This is Uncle Sam saying, once you reach 70 years old, they're wanting you to start taking out your IRA distributions whether you need it or not. And you get into your 80s, you can be forced to take out, several times the amount of salary, the income that you need, and pay unnecessary taxes, a substantial amount, if you allow your Roth IRA to get too large. So you need to be sure to project other forms of income before IRA distributions, because any pensions or annuities are going to have to be taken regardless of what you do. There's no option on them, so they go into your other income. Also, cash flow from real estate, mineral leases, small business like stuff, they go in before you take off your 401k distributions. And also, any taxable income you use from your taxable income funds, including even if you do dividend reinvestments, you still have to pay dividends because they're in a taxable account. Another thing that you want to do is you want to list some possible adjustments that are reasonable and do some what-if scenarios. If you have some pretty high probability near-term inheritances or realistically high odds of income from a business, or you think you're going to be working a certain amount because you're only 62 and you want to work some between now and age 70, you need to jot down some of these as potential increases in your income to see how they would affect your roll strategy as well as your taxes on Social Security. You might want to increase your return on investment for all your investment assets. So if you assume 6, you might want to have a 7% run and a 5% run to see what happens to your retirement funds over the life of your retirement horizon. You really should not depend on the retirement calculators because those are very high level and fraught with too many improper assumptions. You probably need to sit down and pay your financial advisor, $1,500 to $2,000 for a full-blown analysis of all your strategy for retirement funds over your entire horizon of your retirement. Run scenarios with less and more IRA to Roth conversions to see if you're doing the right amount and how it affects RMDs and if you're really going to be taxed properly. This chart really kind of oversimplifies RMDs but gives you a very graphical view of what RMDs can do. So I picked 4 potential scenarios of a Roth IRA size which are achievable by people who are earning around $100,000 a year when they retire and have saved fairly diligently. But if you remember in the spousal scenario, when you reach 70, you only needed $30,000 a year or $33,000 a year, and those can be probably provided by investments in real estate or taxable funds that you need for liquidity. So, you may not need any RMDs. And we turn 70 if you have a $2 million IRA. The Uncle Sam's going to make you pay 25% of that in taxes at age 70, whether you need it or not. So this is why you want to not go into retirement with too large of IRA. You really want to consider some IRA to Roth IRA conversions. Here are some conclusions of this presentation, kind of the takeaways or executive summary of what you should take away from this presentation. The first thing is Social Security is a tax-free source of income, which you can maximize by delaying your Social Security benefits. And probably even at $100,000 a year will probably represent the largest source of tax-free income. So delaying benefits for Social Security is greatly encouraged. The second is the higher incremental taxes only last for about $30,000 for a married spousal scenario and averages around 32%. So even though that's 7% higher than 25%, and you can do some conversion based on that, it's not really the primary reason you want to avoid this kind of taxation. It's more important, though, for IRA to Roth IRA conversions, because many of the CPAs and certified financial planners will not recommend these conversions because they look at the IRS rates, which are 15%. They're going to say you don't need to do it and actually it's 27.75. And so this is a really very obscure way that IRS taxes that is very difficult for many people to understand. If you do not convert some of your IRAs to Roth IRAs, your IRAs will go too much and you'll force RMDs, which will be a big load on your taxation and income. And when you hit in your 80s, it can double, triple, quadruple your taxes in retirement. These forced RMDs not only generate major tax-free ordinary income when you don't really need it, but they also result in growing taxable funds that generate even more taxes. Because once you distribute from an IRA, you'll put it in a taxable income fund, and then it generates yet more taxes. So if you allow your 401ks and IRAs to grow too much, you may want to even consider conversion some up to 28%, because as we all know that taxes are probably going to rise during the horizon of our retirement. So hopefully this presentation has been interesting for you. I know it's a lot to absorb, but hopefully you enjoyed this.